So every month we deliver financial statements to our clients, and every now and then a puzzled business owner says, I got this balance sheet. Why the heck do I care about it? Well, your balance sheet is your wealth statement, and here's why you should care. Your balance sheet is telling you how much wealth you have accumulated in your business, how much it's telling you the value of your time, energy, sweat equity, all of those things over time. So I've convinced you to take this thing out called your balance sheet. How do you read it? What are you looking for? Well, I think the number one thing to look for is your cash against your liabilities. So there's this thing called the current ratio, which means that for every dollar we have in the bank, or a promise for someone to pay us, dollar or cash plus AR, do we have a dollar to cover every commitment we've made to pay somebody else? If for every dollar we've said we're going to pay a vendor or a lender, if we have a dollar in the bank or a dollar in AR, that's a ratio of 1. And bankers like to see 2. So for every promise you've made to pay someone else, you have $2 either in the bank or in receivables. So that's a key number to go check out when you're done listening to this video. And you want to compare those two because the higher that ratio is of assets to liability, the more stable your business is. It means you're going to be more resilient as business and the environment and the economy fluctuate. Lastly, you may want to track your equity balance over time. So what was it this year versus last year versus go all the way back to when you started your business. This is going to tell you whether you're increasing the wealth in your business. Most small business owners that we see are running lifestyle businesses, and the purpose of that lifestyle is to fund themselves, but that business should be self-sustaining. And if it's self-sustaining and funding the lifestyle properly, we would expect to see an increase in equity over time. One of the biggest mistakes that we see is ignoring your balance sheet completely. Business owners almost instinctively and intuitively figure out what the income statement is, and they know nothing else. They know to look for the bottom line, but there's so much useful information about the stability and the health and the future and the past of the business on the balance sheet. So please pay attention to your balance sheet. Make sure your bookkeeper is reconciling accounts on the balance sheet correctly. Now, what do I mean by this? Well, any bookkeeper worth their salt is reconciling your cash and your credit cards, but are they reconciling your loan balances? Are they reconciling other accounts, deferred revenue? That's when you receive revenue in advance of giving services. Those numbers usually start on the balance sheet and they need to be reconciled at the end of every month, just like the cash accounts get reconciled. So you want to make sure the balances on the balance sheet are correct, because only then can you be reassured that the income statement is correct. Also, make sure the bookkeepers are classifying things correctly, that they're not putting things that belong on the balance sheet onto the income statement or vice versa. Either one of those errors will distort the balance sheet and will not give you an accurate picture of the health and wealth of your business. So please go home, fire up QuickBooks, look at your balance sheet, and then get back to me. Tell me what you see.